He's president and chief investment strategist of Point View Wealth Management, which is part of PPAC Private of PPAC Gladstone Bank, one of the country's top wealth managers. And they'll help you anything having to do with investments or money. He's a CFA, CFP, attorney, and a very well-known and sought-out resource for media, including Bloomberg, CNBC, Fox, Wall Street Journal, Times, LA Times, Forbes, US News, Investors Business, and Star and Ledger. His list of what he's done for Summit is too long to read, but he's a very distinguished resident of Summit and member of Rotary.
Thank you so much, Peter, and thank you to the Rotary. It's been a real pleasure of my 25 years here at Summit to have been a member of Rotary for almost all that time, and the friendships and the meetings and the holiday parties and the scholarships it's all been a great, and makes it for a very rich fabric to be lucky enough to be part of. In any event, thank you so much for having me, but you really got a twofer today. And before I go any further, I want to introduce my colleague here, Fritz Schoenhut. We're going to tag team this presentation a little bit. Bottom line, Fritz is a managing director and portfolio manager at Point View. But that's not what makes him famous. What makes him famous really is he spent nearly 6 years at Goldman Sachs as a vice president in their private wealth group in the New York headquarters, and he dealt with the real high net worth folks and institutional clients, serving as primary relationship manager and working on their portfolios, their allocation, and also complex trust and estate planning. Of course, he also spent time as a tax associate at Grant Thornton, where he did all things tax for, again, high net worth individuals. You're catching a theme there. He was well prepared for that. To start with, he is a distinguished grad of Notre Dame in 2011 with a bachelor's degree in finance, but didn't stop there. He's got his master's of science in taxation from Baruch in 2017. He too is a chartered financial analyst and moved out, I guess it was a year ago summer, from New York with his talented wife Gina to Berkeley Heights. And as you may have heard in the beginning of the conversation, are blessed parents of a near 1-year-old son. So the way we want to do it here is to we have a presentation, and Fritz is going to bring that up. And we're going to start with the, thanks Fritz, we're going to start with the title here. Per Peter Bolton's suggestion, I want to focus a little bit on this historic election that just happened. We now know the outcome. It's a Biden presidency, and then look at investing and financial planning through the lens of this new administration. And next, before we get going, just wanted to share with you, next slide.
Good morning, David Dietze here. Who am I? I'm President, Chief Investment Strategist.
I don't know what that is.
Wealth Management.
Let me see if I can, I don't know what that is.
We are delighted to have you join us on this webinar on this Thursday morning here.
Let me see if I can get this going again.
Anyway, I'll keep talking because I've got my own copy here while Fritz works on the slides. So again, we are Point View Financial Services. We are now part of PPAC, effective on September 1 of last year. They managed about $7.5 billion down the road under management there. Why are we so happy to be part of them is, although we're pretty much doing what we've always done, they've got many investment professionals that we can always call upon for some detailed knowledge. They also have lots of financial products as a bank. So every once in a while, clients ask us to look at the liability side of the equation, mortgages, loans for their business and so forth, and have help there. And of course, generally we tell people if they want to use a trust, service trustees themselves, but there's always situations where, for whatever reason, particularly in special needs situations, a trustee is needed, and they're one of the biggest in the Northeast with capabilities both in Jersey and also in Delaware. Got a $1 million relationship minimum, 1% management fee. How do we really part company with the competition? Basically, we're using individual stocks and bonds. Most of the competition, they manage your money and then they turn it over to a fund manager who actually manages the money. And so that's not optimal from our point of view. You got an extra layer of fees, there's less transparency, there's less control of your portfolio from a tax point of view, and often less focus. We see people come in, 20 mutual funds, we run it through the screen, 12 of them own Apple. So you can be sure one fund is selling Apple the same day someone else is buying it, and so you have kind of a diluted mess. All of our assets are custody at Fidelity. Next. And we've been very fortunate to be recognized nationally by CNBC as one of the top RIAs in the country, Investopedia, Financial Advisor magazine. Next. So, election 2020. Joe Biden has been elected president. Remember, one of the three big issues for investors this year has been the vaccine,
Okay.
the presidential election.
You needed to go over some things. It's really hot in here now.
And can everyone mute who's at this point?
Yes. Hi,
And-
it's Alice Campbell. I just joined.
Hello,
Hey,
Alice.
Alice, welcome.
Nice to
I'm
meet you.
sorry.
Join us.
They threw me into a meeting, and I apologize.
That's fine. We welcome you here
Oh,
today.
thank you. I'm very happy to be here.
Good.
So, welcome, Alice.
You're
so
welcome. Thank you.
Three big issues for investors this year has really been the potential advent of a vaccine, what's going to happen in terms of the White House, and also stimulus packages. Well, one has been concluded. Joe Biden will be our 46th president, take office January 20th. Interestingly, though, although we were told by Wall Street about a month before the election that it looked like there was a blue wave, and that was actually going to be the best thing for investors, then as the returns came in, the Congress was much tighter than had been expected. Indeed, with the exception of the runoff race in Georgia for their two senators, the Senate is staying in control of the Republicans at this point. It could be a virtual tie depending on what happens on January 5th, in which case Ms. Harris as the VP would cast a deciding vote. But right now it looks like we've got a divided government. So it's being characterized more as a blue mist and not a blue wave. Now Wall Street's telling us, actually, that's what you wanted. The blue mist is better than the blue wave. And we'll get into details on that. House stayed in Democratic hands, but the numbers were down. And of course, people are spinning that as you wish. It was basically a thumbs down on Trump, but not necessarily an endorsement of Mr. Biden's policies. A lot of spinning going on. But bottom line is no blue wave, no complete Democratic control at this point of both the Congress and the White House, but rather a blue mist. Next. So, if there's one thing that you can take away from our conversation here this afternoon is don't overreact really to anything out there. that's probably a good touchdown for everything in life, but particularly in terms of your portfolio, don't overreact because there's a change in the White House occupant. Now, why is that? First of all, look at history. History shows us that actually markets have done better when the Dems controlled both when the Dems controlled the White House and the Republicans controlled, or at least one of the houses of Congress. That actually was a 15.94% average annual return. Then when the Republicans controlled the White House and the Dems controlled at least one house of Congress, that was only a 7% return. When it's a complete blue wave or a red wave, actually markets work out pretty well there. So you can't allow anyone to say, oh, well, because so-and-so is your president, you might as well take your portfolio and put it under the mattress for the next 4 years. Not supported by history. And I guess the question is, why does the divided situation actually work out better than when one party controls both? Some people think it's because any particular legislation proposal must be so well thought of that both sides can support it, and therefore there's not any kind of knee-jerk changes that might affect the economy adversely. Remember, Wall Street, I think they'll tell you is they can live under any policy, they just want to know what the policy is. And if it flips back and forth every 4 years, that can, or if there's tremendous uncertainty or they feel there's going to be big change, that makes them nervous. Next. You know, and so basically it's fundamentals, not Washington, that's going to drive the economy and the markets. I explain to my clients, they, you know, go on a rant in one direction or the other. I have to listen to both sides. That's my job. But, you know, at the end of the day, I say, well, what's the most important factor as to whether you and your spouse will go out for dinner on Friday night? Is it your job security, the chance of getting a bonus? Or is it who's in the White House or what so-and-so tweeted last night? And at the end of the day, you know the answer is basically how their career and their job and economic security are faring, and not really the White House. The other thing, of course, is that investing is a long-term game. It's, believe it or not, is actually much longer than any kind of 4-year term. Now, Warren Buffett would tell you that your investment horizon is your lifetime. That's probably too far for most people. But the fact of the matter is, as Warren Buffett says here on the left, is that, you know, you're going to have many different administrations during the course of managing your portfolio, so that you don't want to swing too far too quickly as each new president comes into office. You know, the other thing, of course, is I think one takeaway from what we've seen in recent years is the number one issue, as a famous politician once said, is the economy is stupid. So that no matter who's in the White House, if they don't keep that economy strong, jobs plentiful, and quite frankly, the stock market up, it's a tough road to hoe to get reelected. It is that simple. Even today, the midterms are less than 2 years away. And so as many great ideas as Mr. Biden has, at the end of the day, if that economy is not strong, come 2 years from now, it's going to be very difficult to hold on to the House. I think it's that simple. Of course, the other thing when you're trying to jitterbug in terms of, oh, let's do this because this president is going to take office, is you have to say, well, is that something that other people don't know? Now, if you knew in October who was going to win the election, maybe you could get an edge. But to say, oh, actually, Biden's going to be our president, therefore, let's buy this or sell this. It's like, well, who are you going to transact with that doesn't already know that? So you have to assume that every great idea that's now based on Biden being president is already reflected in stock prices. And of course, the quote we have on the left, where Buffett, who's one of our most successful and famous investors, has said that, you know, half the time the person he wanted in the office is not the person who has the office. And he's never, as he said, you know, let that disappointment or ebullience, depending on who's in the office, affect how he was investing his money. And that's worth keeping in mind. Next. But, nevertheless, elections do have consequences. And I think one thing that does look like it's coming down the road is stimulus. Now, we were initially told to be very excited about a blue wave because the stimulus package might be as much as $3 trillion. But now, as it looks like the Dems won't have at least firm control, or maybe not any control, over the Senate, who will know more after January 5th, it looks like that stimulus package, if it comes, is going to be much smaller. Again, as much as I think we need stimulus and the country needs it, frankly, the country needed it 2 months ago too. Why didn't we get it? And when you figure that out, you can realize why there's a degree of pessimism as to see anything quickly in January. I think that, again, it's the other party's economy now. People will drag their feet. It's unfortunate, but people were going to say, well, maybe that's what you did back in the fall. I think the two key issues or stumbling blocks is how much aid to give to the states. The Republicans are saying, well, we're happy to reimburse them for their strictly COVID-related liabilities. We're not going to reimburse them to the extent it represents mismanagement of their budget in periods well before COVID-19. Republicans are also seeking business immunity for COVID-related claims for business. Nevertheless, I think there's tremendous pressure to get something done. We saw the November jobs number on Friday. The number of jobs created fell off dramatically from October. We're well off where we should be. That adds to pressure to get something done. I think there is bipartisan support to give extended unemployment benefits. Beyond that, aid for businesses and states is more controversial. And at the same time, of course, you have one of the most powerful players in the economy, Jerome Powell, saying we need more stimulus. Of course, he knows that if there's not more stimulus and the economy goes south, he'll get blamed. So of course he's going to say that. Next. Okay, so another reason to be optimistic based on a Biden presidency is infrastructure spending. Now, this has been something that people have been talking about for the last decade. We need more infrastructure. Our roads and bridges are crumbling. We need a new tunnel going into New York from New Jersey. And of course, at this point, you could include more broadband service to all nooks and crannies of this country, a little bit like extending telephone service in the 1930s. All that would be great and improve the efficiency of the economy. And I think there's probably bipartisan support for that. There's probably, with Biden in the White House, maybe a little bit more support because traditionally, the Dems have been bigger spenders, but in the last 10, 20 years, no one seems to be worrying about spending at all. The adverse effects of deficit spending has been, historically, economists have warned about inflation, higher interest rates, but quite frankly, that's nowhere to be seen. So bottom line, I think big infrastructure spending is something we can look forward to under Biden administration. That would be a positive. Next. Next. So one big concern that people tell me, oh, well, let's go back into our rabbit hole in terms of investing during the Biden administration because he's going to raise everyone's taxes. Well, I think the key one from the stock market point of view is corporate taxes. I think the bottom line is that as long as we're still worried about COVID-19 and where the vaccine is, I don't think there's going to be any type of taxes imposed. And that could be, quite frankly, years. And I think the reason is because what everyone's looking for here is fiscal stimulus, a way to give a boost to the economy. And I think nearly every economist would tell you that increasing taxes, reducing the amount that corporations have in their coffers, is a drag on the economy. And so therefore, between that well-known effect plus probable Republican control in the Senate, I just don't see corporate taxes changing anytime soon. So don't get out of the market because you're worried about higher corporate taxes. And in fairness, even if they go back up, Mr. Biden's proposal is not to take them all the way back to where they were before Trump reduced them, but just to take them halfway back. And that would increase the tax burden by a quarter, but only reduce profits by 7%. Would that be a positive? If it was coupled with a big infrastructure package, I think you could argue that would be a positive for the economy and a tailwind for the market. So don't worry about corporate taxes as long as you're worried about COVID-19. Next.
Just press pound to continue.
Okay, press and pound. The other concern, of course, is higher income and capital gains taxes. So what was talked about during the election was that the president was going to raise income taxes on those making more than $400,000 and higher capital gains taxes. Just to put it into context, right now, if you sell a stock held 12 months or longer, the taxes on that are approximately half what you would pay on salary income or CD income or something like that, capital gains rates. And Mr. Biden during the campaign talked about making capital gains taxes equal, in effect doubling them. For those making 1 million or more, the idea is why should wealthy people who are making great trading profits pay taxes at a lower rate than the working folks who are paying the full rate on their salary income? And, there's a lot of logic to that. Of course, the politicians all have big stock portfolios too. So we'll see what happens. Certainly, all of this is a bit less likely given divided government. And again, it would be another way to put drag on the economy. So again, although a lot of fairness logic comes into play, just not sure at this point, as long as the Federal Reserve is worried about more monetary stimulus for COVID-19 and people are worried about jobs. I just don't think that's going to be the top priority. So I don't think it's going. I'd be surprised actually if it happens in the next 2 years. Next. So we've talked a little bit about some things to look forward to under a Biden administration. What are some ways to play it? Well, talking about ways to play it is a little bit inconsistent with our original thoughts, which is basically don't restructure your portfolio or make big moves based on who's in the White House. Nevertheless, there are areas that perhaps could do a little bit better given a Biden administration. And I think one of them might be in the cyclical and value stock area. So why would that happen? Well, we have seen during the economic turndown that people have turned to the stay-at-home plays, your Zoom as we're using now, other technology devices that allow us to be more productive at home. We've been paying the pizza delivery man a lot of money. Clorox and Lysol are doing quite well. But if in fact the fiscal stimulus comes in bigger than expected, particularly insofar as infrastructure gets the bipartisan support, the rest of the economy should pick up. And coupled with the vaccine coming on board, we could see the so-called GOAT plays, which is get out and travel stocks, do a lot better since they've been so beaten down. And that would perhaps motivate you to tilt your portfolio towards cyclical and value. Now, why dividend stocks? Dividend stocks have not done well this year. Basically, people buy them for dividends, and there were such fright out there that with the downturn in the economy, the dividends would be reduced or terminated. In fact, that happened a little bit. Now they're starting to come back, but as the economy improved, the dividends could not only come back, but also be boosted, and that would give a tailwind for that area. Fixed income, perhaps reasons to be cautious. If the economy does improve, there'll be more loan demand that could push interest rates up. There could be a little more whiff of inflation that could cause lenders to seek a little bit more money on their when they lend it out and buy fixed income. You could see the Federal Reserve push back a little bit from their monetary stimulus. Now, they've promised everyone that we're have very low rates the next 3 years, but the fact of the matter is the futures market, which predicts what they might do several years in the future, pulled forward by 1 year their change in monetary policy on the day, or the week anyway, that Pfizer announced the success with their vaccine. We think real estate might do well. Remember, real estate you can buy outright, but you can also buy it on the stock exchanges in the form of REITs, which are basically companies, partnerships, which own real estate. And they have this special tax advantage, which is they don't have to pay taxes. They're treated as a pass-through, unlike corporations. And so if tax rates ultimately do go up on corporations or are feared to go up, people might gravitate also to REITs because if they're not going to pay taxes, they don't have to worry about higher taxes. And finally, municipal bonds may get a little bit more traction. If tax rates do go up for the wealthy, they're going to be looking for more ways to reduce their tax bill, tax dodges, whatever you want to call it, and municipal bonds as tax exempt from federal taxes, and indeed also from state taxes if issued within the state that you are a taxpayer of, could look more attractive. Now, at this point, I'm going to pass the baton over to Fritz to talk a little bit more about potential investment opportunities.
Thank you, David. So cyclical and value stocks. So David touched on this, just briefly, but they have been long-term underperformers, and by long-term we mean, certainly this year, but also over the past about 10 years or since the bull market began about a decade ago. And so when we look historically over the entire history of the market, these dividend payers, the value cyclical stocks have tended to outperform the market and growth stocks, but certainly more recently and this year that has not been the case. And if you look at the chart down at the bottom, this shows in green the Russell 3000 growth index. And so the Russell 3000 is basically the 3,000 largest stocks, or almost the entire investable universe of U.S. equities, and just taking the growth stocks of those versus in blue that same group of stocks, but the value the value stocks in that grouping, and you see just this year a massive outperformance of nearly 35% for growth stocks, and if we kind of look in different time segments, though, really since September 2nd, we started to see this reversal into the value stocks from growth. And I think at that time, it didn't seem much other than maybe a shifting of the investor sentiment towards these growth stocks that have really ripped up through August into more of these unloved areas of the markets, and that's part of one of the reasons why we think there's opportunities there, is because they're possibly better positioned to take advantage of the further normalization of the economy, further additional fiscal stimulus, as well as infrastructure spending. So as they are more cyclical or more exposed to the broader economy, as things start to turn around, the more value oriented stocks should continue to outperform that we've seen since September. Another area of the market that we like right now is small caps, and so that's another area that should certainly benefit from additional stimulus. So small companies are distinguished from larger ones basically by their market capitalizations. And if we go back through history since 1926, small stocks have tended to outperform large stocks, and over that time, on an annualized basis, by nearly 2%. We haven't seen that this year, and in recent history, it's really been these large, big, ultra large tech companies and other large cap stocks that have really been outperforming. And so, in what going forward do we think that gives small stocks the opportunity to outperform? And, obviously the stimulus is one of those. But, after a period of really lagging the S&P over the past 5 years by nearly 7%, they currently stand at much cheaper valuations, about 10 to 20% less than large caps, even though historically they are often more expensive. And so we think that there is this potential for a reversion to mean as people start to allocate more towards the small cap stocks, which are more, similar to the value side, more exposed to the economy. Take the example of, the Walmart and Targets that have been able to stay open in your neighborhood, whereas a lot of the smaller mom and pop type shops have been closed down during the this pandemic. As things start to normalize and things start to return to normal, there is potential for these smaller companies to start to outperform and really start to catch up. And so an additional area that we think they could benefit from is really from their focus on the U.S. consumer. They are less exposed to overseas economies, and so if there's any potential for trade wars to continue on, small caps should bear less of the brunt relative to these much larger multinational corporations. And then lastly, just from an interest rate standpoint, there is more exposure to financials in small cap indices than in the large cap. And so, if interest rates do begin to rise and the economy improves, the financial sector should flourish, or start to hopefully flourish. We're probably far away from that, but. So dividend stocks, as David had mentioned, there's an area here in the market where there's a lot of potential, but there's also with tax changes maybe coming down the pike, how will that affect the dividend payers? And so, historically, and if we look at this chart, this is really just the past 5 years, but going back much further, dividend payers have outperformed the broader market because that dividend makes up a sizable portion of the total return. But if you look at this chart, there's a steep drop in January, February of this year and March of this year, where in blue, the S&P High Dividend Index really fell hard as the future of the cash flow of companies, the future of their ability to pay dividends is really put into question, and investors sold out of those stocks because many people hold those for their cash flow. And then the green, which is the broader index, held up generally well because of their exposure to the less dividend payers and more these high growth companies that aren't spitting out dividends to their investors. So as more recently, as companies have, or as markets and investors have shifted toward greater growth, people have become a little more skeptical of dividends in recent most of this year, up through about September when we started to see that reversion back. So how do investors go about trying to figure out where should I invest my money if I'm looking for dividend paying stocks? And one list that we like is the Dividend Aristocrats, which is a list of companies that have increased their dividend on an annual basis for 25 years. So it really shows a commitment to paying back out to investors, and not just paying it out at a flat rate, but growing that. Now, of course, when you're looking at history, that's history. It's no telling of what's going to happen in the future, but it does show a commitment to that dividend. Healthcare stocks. So will it be business as usual? So around election time, and we've seen this, be especially true in the past couple of elections, healthcare stocks are really put under pressure. And a lot of this has to do with, the debate and discussions around, the single payer system, reining in their costs and the pricing control. And at times it was, they are kind of moving offshore to play the tax game. And so, it's really been this kind of back and forth between, kind of what people's thoughts are on healthcare stocks and what their futures hold. But if anything, this year there has been almost this renewed respect for a lot of these major pharmaceutical companies and healthcare companies, because of their role in fighting the virus. So you look at Johnson & Johnson, you look at Gilead a little bit earlier on, and you look at Pfizer and Moderna. They've all had a key hand in, or hopefully will continue to have a key hand in kind of turning this around. And additionally, Joe Biden being chosen as the Democratic candidate and now being in president indicates a more moderate tone or a moderate approach towards healthcare. I think on the more progressive faction of the Democratic Party, there was maybe calls for the single payer system, but by having Biden in office and kind of leading the party, it shows at least a maybe perhaps more of a moderate approach to any sweeping regulatory changes that the healthcare landscape will see. And then lastly, a lot of investors follow Warren Buffett, as David had mentioned earlier on a couple slides ago. But the announcement of Berkshire Hathaway taking major stakes in Pfizer and Merck and AbbVie, they're not making any. He's not really trading in and out of positions, and they're more long-term investors and they're seeking value. So if anything, that's maybe a sign that, one of the most respected investors, in the world today and in one of the most in history, taking stakes in these companies is a good sign of faith. And then, so lastly, tech stocks, they're too successful for their own good. So as you've seen in a couple of the charts, the tech and growth stocks, but really tech stocks have soared this year. And, with the coronavirus and the stay-at-home orders, the stay-at-home trade became the hot thing. It's really not too surprising that you've seen companies like Amazon, like Zoom, that are taking over our daily lives, really, as we replace going to the mall and going to the movies with shopping on my phone and tuning into Netflix and speaking with my friends just like we are on Zoom here. So they've really taken off this year, but so too have a lot of the attacks on these major tech companies because of their privacy issues, potential more monopolistic behaviors. And around the election as well, a lot of, discussion and calls for change in terms of, how they are policing social media and are they publishers or not? And then, of course, overseas, the issue with taxes, that's another, issue that hasn't really been, discussed too much here in the US because it's more so maybe in Europe. But, with all of these things up in the air, we consider valuations to be a bit unsustainable after just such a strong run they've had. So certainly, tech is the future, but there's no telling kind of what tech is going to outlast the rest. And as they say, this creative destruction, what new technology is going to come up and take the place of the Apple iPhone if you have it. So in our view, we see and as an example here, we may be heating our homes with fossil fuels longer than we'll be using the iPhone. So certainly technology is a major part of our life, and we use it every day in almost everything we do. But there's no telling that any one company is going to continue to be the cream of the crop. So with that, I'll turn it back over to David, and we'll take some questions.
Yeah, thank you so much, Fritz. Well done. We've got a couple minutes, I think, right, Roz, to take some questions, and sometimes the most interesting things are ideas that you shoot to us here. So talk away. Fritz, you maybe want to make the gallery screen again. Take this slide off.
Yeah.
Stop sharing.
There we go.
Mort, it looks like you're unmuted. What do you have to say?
Here's what I'd like to say. Let's do some questions. And thank you, David. And thank you, Fritz, for really a very comprehensive presentations. I think we all benefited from your wisdom and know-how. Who'd like to begin with some questions?
I'd like to make a comment. I think presidents get too much credit when the stock market is up and too much blame for when it goes down. So I agree with you, David. We're probably in good shape with Biden as president.
Susan,
I think that's,
thank you, Mort.
Yeah, I think that's consistent with one of our themes here, which is, you know, don't invest based on who's the latest occupant. They're not as influential as many other fundamentals. And of course, the corollary to that is they really don't deserve the blame or the credit when things go well or don't go well.
Dave and Fritz, and especially in the 80s, I was always taught that when the economy went up or south, that was a precursor as far as what the general economy was going to be in the future years. But when you see today the stock market at record earnings and Main Street hurting so much and many sectors of the economy doing so poor, it just seems like there's such a dichotomy as far as the stock market versus what's reality out there. And do you have any comment on that? Or am I wrong?
Yeah, Bob, that is such a great question. And I think a lot of us are feeling, you call it dichotomy, I might call it disconnect, where we came in today with all four stock indices, including the Russell 2000, at all-time highs. We haven't seen that since 2018, yet we know that based on just the latest jobs report for November, that the unemployment rate is unacceptably high at close to 7%. Only 245,000 people found jobs, and things are deteriorating fast. We just heard the very sad news about enhanced stay-at-home orders in California as an example. So how do you reconcile the two? I think the key thing is that stock prices are leading indicators. Things like jobs reports in the rearview mirror. So remember, when you buy a stock, well, the stock market today sells at 22 times earnings. Times what earnings? Earnings in 1 year. So you could make an argument that when you buy a stock, you're buying the earnings not just for next year or even for the 4 years of the Biden term, but for the next 20 or 22 years. And so people are looking past the current conditions. The storm is bad, but will the eye of the storm pass and things get better? And I think certainly we have seen since the historic news on the 95% efficacy from both Pfizer and Moderna and AstraZeneca of a vaccine, that once those vaccines get distributed, it's not going to be by year end, it's not going to be in Q1, but certainly over the next 6 to 12 months, the vaccines will be distributed, and all indications are that's going to be a tremendous boost in people's health, people's confidence, and therefore the economy, and that's what stocks are pricing in.
Thank you.
Susan?
Susan, you're on mute.
You're muted, Susan.
Susan, you're muted. Unmute yourself.
I think she's saying go ahead.
Yeah,
She knows she's muted. She can't.
She knows. She can't
Okay.
unmute herself. Okay.
Yeah, Susan, if you want to put it in the chat, you can drop it in the chat also.
Now we have Vito.
Yeah, I'll just jump in while she's figuring that out. You know, on this issue of disconnect between the real economy and the financial markets, I'm thinking of in my area, housing, where there's such distress and unpaid rents and fear of mortgage defaults and deferrals, and you know there are the inequality issues that are out there. How does this all, and even issues of global warming? There are issues that must impact the financial markets, certainly affecting real life, and our quality of life. How do you relate to those issues? How does the market relate to them?
Yeah, so after the vaccine, probably the most important characteristic of what's going on that's driving everything is interest rates. I think most financiers will tell you that the worth of anything is based on the total value of the stream of cash flows, whether that's rents or whether that's mortgage payments or whatever, or profits from business, present valuing that. Now, the key to present valuing it is what the discount rate is. And as the discount rate goes small, $1 in 10 years from now is worth very close to $1 today. When the discount rate is big, $1 10 years from now is worth a lot less today. So, you know, that is driving up prices of all real estate generally. We all know if your grandchild or son or daughter said, Dad, Mom, is it a good time to buy a house? What are you going to tell them and why? You're going to say, actually, it's a great time to buy a house because, whoa, back in the 70s when I bought our first house, we had to pay 8% interest, and now you guys can get it for under 3% interest. And so that's a huge tailwind behind all real estate, just like the stock market too. It's the same house, but it's worth more if your monthly payments are less, okay? So then drilling down, of course, we know real estate is not one big amorphous blob. We know that the malls are under tremendous pressure because, well, for example, in California, you're forbidden to go to the mall, so they're not going to do very well. On the other hand, we know that suburban single-family dwellings are very hot because people want to get into less dense living areas and have a backyard where their kids can play, so those are going through the roof. Where do apartments fit in? Well, you're absolutely right. Right now, they're under tremendous pressure. It's very sad both for tenants and landlords alike. If the tenants don't have a job or are working only part-time, they're having trouble making those rental payments. They don't make the rent payments, then the landlord has trouble putting together the money to pay the mortgage on the building. It's a vicious circle. Having said that, the reason to be a little bit optimistic is, of course, that if these vaccines do their thing and the rest of the economy opens up, then the unemployment rate will go down, people's cash flow will improve, and they can start paying the rent. So I would say, as a general proposition, most real estate looks kind of attractive here going forward, if indeed you agree with me that the economy should improve. Climate and global warming is a whole other topic, and that's a perfect segue to give Fritz a chance to weigh in on that one.
Yeah, I mean, I tend to agree with David there. Not much more to add on that.
Okay, Susan, did you get unmuted?
I finally found my, I could hear you, but I could do everything but see. Anyway, thanks again for David and Fritz. So I did want to build on Vito's question. The global warming predicament is really hard to get our minds around, but surely after the California extremity and the number of people adversely affected and the nearness of health and the natural world, that we're on the verge of just most people understanding that health is directly linked to the natural world. So I'm just trying to figure out how is it that the analysis can still stay delinked from any mention of the natural world and the health of the natural world, because clearly we're not sustainable. Humanity is not sustainable. I know this kind of gets beyond finance, but it doesn't. It is finance. So When do you think that big tipping point is going to happen? It might be 6 months, it might be a year, it might be a year and a half, when the general public understands that we need to make huge changes in our lifestyle in order to have a livable future. I can see that
Yeah,
Fritz is
absolutely.
smiling at that.
Well, I'll start and Fritz will correct me here. But, so I would say certainly we're better off with the Biden administration than was otherwise in place, because we're more likely to, I think where economics comes into play, the problem is externalities. If one person burns recklessly and emits pollution, it affects other people, but the person who is polluting is not paying the price that reflects the harm that's being imposed on others. And by skillful use of taxes and credits and so forth, perhaps you can use economics to get people to consider, look, if I buy a gasoline car, look what I'm doing to the environment. It should cost me more to get that gasoline car, to tilt the playing field so people do the right thing. So that's where there's hope going forward, and perhaps there can be bipartisan support, because as you point out, things are getting worse and worse. Now, in terms of how you play that from an investment perspective, it's very difficult, because you've got to take the position that your outlook on climate change is superior than the people at, let's say, Fidelity Investments or BlackRock and so forth. And I think that it may well be, but it's not a snap decision there, because I think we've already seen lots of fossil fuel stocks be sold off, partly because of that. And so, the question is, are they going to lose their business even more quickly than the market has already surmised? A lot of people like, alternative energy stocks. I'll give you an example. Fuel Cell, which makes batteries and so forth, went up 245% since the election date. It went from about 4 to 9. And of course, what does any smart financier do running Fuel Cell? They said, okay, we'll do a new stock offering so we can take advantage of this skyrocketing price here, which far exceeds what our cash flows look like they're going to be anytime soon. The problem is the stock offering was at 6 and the price is at 9. So people got their fingers burned there. So I think, at the end of the day, I think people should, communicate with their representatives in Washington, but certainly from an investment point of view, stay very diversified. And of course, what's the most interesting thing is some of the European energy companies, BP, Eni in Italy, Equinor in Norway, they now have big investments in wind farms. They're not going to go down and say, well, it's our way or the highway. No, they're reading the tea leaves quickly and changing their business. So some of the more interesting stuff may actually be under the roof of some of the large energy companies who, of course, already have the infrastructure. They don't really care what you buy. They just want to be part of the process.
Thanks. I have one more quick civics question, unless somebody else has a question.
Go for it.
Because Rotary is civics. So you use a term that I hear all the time in the news media, and I have to say it makes me cringe, and that is, you use the word control. Will the Democrats control the House? Will the Republicans control the House? And as you know, that's become a cliche, but it's probably civically a pretty bad one, because it really means, do the Democrats have a majority? And unfortunately, the word control, when pilots use it, when they say I'm in control, they mean total control. So it's constantly implying that you have a one-person majority in Congress and you have total control over Congress, which is the worst thing we can be doing. Have you thought about that, or do you want to just kind of lead the way, David, in getting back to saying it's a majority and not a control issue?
Yeah, I mean, among this august group, which is why I'm so happy to be part of Rotary, I think there's a lot of people who have some great thoughts on that. But I mean, you're absolutely right that each member of Congress, of course, represents their own jurisdiction. And so ultimately, in some ways, their loyalty is to the people who elected them in the jurisdiction they represent. They do form coalitions to achieve mutual goals. But, at the end of the day, I think most people get involved in the job because they want to improve society. They want to improve the law of their jurisdiction, and they don't want to have any one person, Mitch McConnell or anyone else, telling them exactly what to do. So I think it probably overstates how Washington operates.
Thank you. I have hope.
Quite provocative questions, very masterfully fielded and answered, and we certainly want to express our appreciation for your very timely and helpful and elucidating presentation. So there you go.